Hello everyone, welcome to the weekly lecture videos once again. And in this video, I'm going to discuss the third learning objective of chapter 3, um, the determinants of firms' profitability and growth. We will start with the DuPont identity. You perhaps recall we learned about return on equity previously, which is the return available for equity holders, and we calculate it as profit for the period divided by total equity. So when, for example, this return on equity is 10%, it means that for your investment as equity in a company, you earn a 10% return. Okay, so $10 for every $1 or every $100 of your equity investment, right? Now, this DuPont identity is a popular expression of ROE, I mean return on equity. And return on equity can be expressed as a product of three different ratios. Okay, so profit margin, total asset turnover, and equity multiplier. So which means that this return on equity essentially is generated by multiplying these three separate ratios. Okay, so profit margin is profit divided by revenue. Total asset turnover is revenue divided by total asset. Equity multiplier is total asset divided by equity. Okay. Now you might be wondering that why this return on equity depends on these three ratios. Look, try to understand theoretically what is return on equity, the profitability a company earns for it as equity holder. Am I right? Now, this profitability is generated, first of all, from how much profit company earns from its revenue, okay, which is called operating efficiency. That means how much the profit is generated, okay. Then total asset turnover, um, which is asset use efficiency, and then the leverage position. Okay, that means how much efficient a company is in generating profit from its revenue. So how much you are efficient in your cost management. Then total asset turnover is how much you are efficient in your asset management. And finally, how much you are reliant on your external financing. Okay, so these three combined, they make up how much return on equity you generate. So for example, profit margin is 16.7%, total asset turnover is 0.64, and equity multiplier is 1.39. So return on equity is 14.9%. Now try to understand this point. If a company earns higher profit, if a company is more efficient in managing its asset, if a company is more reliant on equity rather than debt financing, so the company will be generating higher return for its equity holder. Okay. So by this time, you understand that considering this DuPont identity, weakness in either operating or the asset use efficiency, that will reduce your return on equity, right? Which means that, let me get it again. So if you are not efficient in managing your expenses, if you are not efficient in managing your assets, this profit margin, total asset turnover declines. So will be your return on equity. Okay, this is one point. And another point is it also appears that a firm could leverage up its ROE by increasing its amount of debt, right? It turns out that will only happen if the ROA exceeds the interest rate on debt. Okay, which means that you remember we learned about ROA. So if your ROA is higher than your cost of debt, okay, cost of debt, then higher debt will increase, using higher debt will increase your ROE. Okay, however, keep it in mind that as you use more and more debt, your cost of debt will go up and your ROA will not be enough to offset your cost of debt. And in that case, using debt will not increase your return on equity. Okay, so let's move to the next one, internal and sustainable growth. Okay. Look, a firm's return on assets and return on equity are frequently used to calculate two additional numbers, both of which have to do with a firm's ability to grow. Okay. And these are, for example, dividend payout ratio, and retention ratio. So these are very simple. So dividend payout ratio is cash divided by profit. That means what proportion of profit is distributed as dividends. For example, when dividend payout ratio is 37%, which means that 37% of your profit is distributed as dividend to the shareholders. And retention ratio is 1 minus payout ratio, and you can say it is 63%, which means that when 37% of the profit is distributed as dividend, which means that 63% of the profit is retained with the company for future investment. This retention ratio is also known as clawback ratio. Okay. Now, you keep it in mind that why we are discussing this under this internal and sustainable growth. You understand that if a company has a higher retention ratio, it means that a company is retaining more of its profit. So that should contribute to a higher growth to the company. Okay, we will be discussing this point more detail. Okay. Now, one is internal growth rate. Look, one is internal growth rate, another is sustainable growth rate. Okay. The internal growth rate tells us how much a company grow using its retained earnings. Okay, so as we have seen in the last slide, that retention ratio is, for example, 63%, and more retention means higher growth. So if a company retains its earnings, that means a company uses its internal financing, how much growth the company can achieve, that is internal growth rate. And sustainable growth rate is how much a company grow using its internally generated fund as well as by issuing debt. Okay, because a company will typically be using both internally generated fund as well as they will be raising money from outsiders as a debt. So sustainable growth means how much a company can grow by combining these two sources of funds. Now, determinants of growth. Look, in the previous slides, we saw that the return on equity could be decomposed into various components using the DuPont identity. Since ROE appears so prominently in the determination of sustainable growth rate, as we have seen in the previous slide, the factors important in determining ROE are also important in determining growth. So we already have seen that ROE depends on profit margin, asset turnover, as well as financial policy. Okay. So if we examine our expression of sustainable growth, we have seen it in the previous slide. Sustainable growth, we can see that you can see this ROE is here. So anything that increases ROE will be increasing the sustainable growth rate. Am I right? Okay, so putting it all together, we have is that firm's ability to sustain growth depends on its profit margin, its total asset turnover, and its financial policy, as well as its dividend policy, right? So profit margin, we all understand that an increase in profit margin will increase firm's ability to generate funds internally, so that will increase its sustainable growth, right? Total asset turnover, that is asset efficiency, asset management efficiency or asset utilization efficiency. So an increase in the firm's total asset turnover increases the revenue generated for each dollar of your money invested in assets, right? So this decreases the firm's need for new assets as revenue grows and thereby increases the sustainable growth rate. Okay. So notice that this increasing total asset turnover is same as decreasing capital intensity. Financial policy is the optimum debt to equity ratio. So look, an increase in debt to equity ratio increases firms' leverage, financial leverage. Since this makes additional debt financing available, it increases the sustainable growth rate. Okay. And last of all is dividend policy. Dividend policy relates to the choice how much you pay to your shareholders as dividend. A decrease in the percentage of profit for the period paid out as dividend will increase the retention ratio, right? We discussed this point earlier. And this increases internally generated equity and thus increases internal and sustainable growth. So in short, this is how we calculate internal growth rate and sustainable growth rate. Okay. So this is the end of our discussion on learning objective 3. The last video will be, the next video will be the last video this week, and where we will be discussing some other issues, limitations, pitfalls associated with ratio analysis and financial statement analysis. Okay, so thank you very much.